For more on the latest slate of earnings, we are joined right now by Hightower Advisors portfolio manager and CNBC contributor Stephanie Link. Steph, I want to talk through some of these earnings with you, but very quickly, what do you think about the credit downgrade for the United States? Would it stop or change your investment strategy in any way?
No, not really, Becky. And I'm not really surprised, just given all of the circus that's happening in Washington. So I think this is just, it's not positive at all, but it's not certainly going to change anything in terms of the way I invest, and just focusing on fundamentals. And as you mentioned, focusing on earnings, which, by the way, have been coming in better than expected.
Yeah, they have on a lot of levels. But there are some different things when you run through. Let's talk about Starbucks maybe first. That came out last night. Yeah. This is a stock you own, right?
I do. Mm-hmm.
So you beat on earnings, but missed on sales.
Yeah, I kind of like digging in deep. There's not a lot that really surprised me, and certainly nothing on the negative side. If you have earnings that are growing 19% and total revenues that are growing 12.5%, operating margins up 140 basis points, and operating income up 10. I know people are focused on global same-store sales. They came in at 10. People were thinking 11. But if you look and dig through the details, North America was up 7% same-store sales, a little bit less than the 8, but they had better segment margins. They actually beat, that's on the segment margins, by 120 basis points. And then if you look at international same-store sales grew 24%, but China grew 46% versus 3% last quarter. I mean, certainly the reopening is happening on the consumer side in China, and I was very pleased to see that. And oh, by the way, their segment margins in the international side came in at 19%, and that's versus 12.4% last year. And you had membership growth.
Higher prices? What led to the higher margins?
Yeah. It's definitely higher prices. It's better volumes, too, right? And so it's the operating leverage story that we were all waiting to see, and we're now starting to see it. And so, everyone was complaining last quarter that China same-store sales only grew 3%. Now China's growing 46%, and no one's giving it credit. So to me, it's kind of silly. And when I look at members grew 15% year over year, and they're up 86% from 2019 levels. So I think all things are going well for Starbucks, and maybe people wanted this huge beat, but I just think the fundamentals are really very sound, and the stock has lagged. And by the way, Yum Brands just reported that stock trades at 27 times, and you're only getting 13% total revenue growth for Starbucks. It's actually trading about the same in terms of valuation, and we also have pretty good, probably comparable in terms of total revenue growth as well at 12.5%.
Are you buying additional Starbucks shares today as a result?
I would, absolutely. I think that this new CEO, he totally gets it. He underpromises and overdelivers. If you look at his track record, you still have Howard Schultz on the board. You have a great CFO, and I can't wait to listen to that conference call, at 8:30 this morning with you guys. I just think they're doing everything very well, and I just don't think that it should be lagging here at these prices.
What about CVS? That stock was out this morning, or that company was out this morning with earnings. Looking at the stock, it looked like it was hard to see where it was going to open, a little bit of a mixed bid and ask. But CVS is so big at this point. They've bought up just about everything. Okay, you can see it's up 2.2% right now. They've bought up everything. They do have a lot of moving parts, though, I think, as you pointed out with this. What do you think of the company?
Yeah, I think this is a really interesting story, and it's not really an earnings story at this point in time because there's a lot of moving parts. But I thought a good quarter, and total revenue's up 10%, a little bit better on the margin front. They have done $19 billion worth of M&A in the last few years. And I think investors want to see synergies from that M&A. We want to see the return on investment from all of this aggressive change to the primary care strategy. So I think that's going to take time for people to appreciate it. But I think there is synergies to be had. But I also think that they've got a really high cost structure, a $40 billion cost structure that they can actually really chip away at. And as they do that, they can then talk about how they're going to return cash to shareholders over time, and I think that is going to be a very big theme for the company as well.
Let's do a quick take. We're almost out of time, Steph, but let's do a quick take on Qualcomm. That stock is up more than 7% over the last 5 trading days.
Yeah, this is an interesting story too, Becky, because I think they already lowered guidance, right, last quarter for this quarter. So expectations are low. The stock's only up 19% year to date. The SMH is up 48%, so it's really lagged. It trades at 16 times. We have to get through the handset inventory issue. Handsets are 86% of total revenue. So I think we have to get through that. We will in the second half of the year. And I think that as a result, the setup into the second half of the year is actually pretty attractive.